Kim, thanks very much for joining us on Zoom. Just for those who don't know, just give us a little bit in terms of Fidelity, but also your role there.
So Fidelity, big private asset manager. We cover all asset classes, and the coverage across the business is across Asia, Europe and Canada, but excludes the USA. So it's a global business, and certainly from an equities and fixed income perspective, it is a global business. From a real estate perspective, we only have direct real estate investment in Europe and the UK, and we have exposure to the UK and what we call core Eurozone, which is France, Germany, Benelux. And my role is head of real estate research and quants, and risk sometimes as well, depending on which title I'm putting on the business card at the moment. But yeah, sort of basically supporting the direct business.
And we're in obviously a very almost unique position, certainly as I remember it, in terms of the crisis around the coronavirus. How are you seeing that from a research point of view? And also, I suppose, given that Fidelity is across a series of different assets, not just real assets and real estate, are there things that you're sort of picking up from the rest of the business that might be influencing what's happening in the real estate property arm?
As a head of research, obviously a lot of people are coming to us to think through what the implications, particularly of taking some of the economic expectations and running that through to what that means for real estate performance. And it's hard because there's nothing like this. You know, you can't just go, oh, well, it's definitely like the 2008-9 recession, because it's not actually a financial crisis, but there are elements of liquidity issues that we're seeing across the globe that make you start to think, well, there are going to be a few of those issues. But it's also a bit like, if you want to go all the way back to 1992, it's a bit like one of those big classic supply and demand recessions as well, because we have both the supply disruption that came through from China at the beginning of this crisis, and now the huge demand disruption that we're seeing across Europe and North America. So there are elements of that we can learn from. There are elements of the financial crisis we can learn from. But the reality is none of us have ever worked through something that's been such a complete shutdown of an economy for hopefully what's going to be a relatively short period of time, but still an enormously disruptive element. So at Fidelity, we're definitely trying to really leverage off working with our colleagues, particularly in Asia, who are a good 6 weeks ahead of us in all of this, and also trying to leverage off what we're seeing in fixed income markets, in equity markets, because obviously they're responding much more quickly than direct real estate can to this crisis. So I'm regularly joining calls with the equity analysts, with the fixed income analysts across different sectors, just to see what they're seeing in the market and understand how we might take some of those lessons learned into thinking about what that means for European real estate.
And I know this is obviously, we're in the midst of it in Europe, especially. In terms of the timing, do you see it following a line like Asia?
I think we can learn quite a bit from the Asia trajectory. I think what we do have to recognise is that each government and each country has tackled it a little bit differently. So you have to be careful of sort of drawing one-to-one parallels. But I think it is interesting, certainly watching how Chinese businesses are trying to get back up and running in terms of the pace at which they've been able to do it, some of the issues that they're now hitting. I think we have to also be aware that, places like South Korea are another very good example, but they've tackled it again in a different way. Perhaps there's more parallels between South Korea and Germany, with a real focus on testing and isolating. So I think that you'll see a very different pattern of business recovery there as well. So yes, I think there are lessons to be learned, and certainly we can start to draw parallels, but we do have to be careful that the way that the different governments have been implementing this has resulted in different patterns coming out of it as well.
In terms of the industry more broadly, what's your sense of what's going to be happening in terms of rents, the sort of landlord tenant process there? Do you expect there to be cooperation, collaboration? How do you see that going forward?
I think that I'm hoping that it will be collaborative. Certainly, from a Fidelity perspective, that's the way we're approaching it, on a tenant by tenant basis, working with them, understanding their cash flow positions, their business issues, and trying to make sure that we work together to find solutions. I have heard that relationships have been more confrontational between some landlords and tenants, and we require tenants to be honest in this process as well. So we've certainly had tenants who have jumped on the opportunity when they've heard governments calling for landlords to give them rent holidays, just asking for them without actually having a genuine business need for them as well. So I think there has to be a recognition that landlords collect rents for a purpose as well. We're not the bad guys in this, certainly, and I think this is going to be a real focus. My view is that this is going to be a real challenge to the real estate investment business. If the funds cannot collect the rents, then the raison d'etre for investing in direct real estate starts to really deteriorate. So I think we've got to make best endeavours. We've got to work hard with tenants. We want them to obviously come out of this with viable businesses, because we want them to pay the rents for much longer. So I think there has to be give and take in this. First of all, in terms of landlords understanding what tenants' needs are from a cash flow perspective immediately, and then perhaps tenants understanding some of the additional needs of the landlord long term in terms of collecting data and information about the properties, be it ESG requirements for electrical use, waste recycling, water usage, and other sort of data about how the building is being used and how the tenants are utilising the space, because I think that all builds a much deeper model of using buildings effectively and efficiently from an ESG perspective in the longer term.
And is your sense that things will go back to normal, or do you see that there are actually going to be some shifts in terms of some of the trends influencing the real estate markets, whether that's to do with office use, home working, whether that's to do with shopping online, those kinds of things?
This will result in some changes. Interestingly, a lot's been said about shopping online, but again, picking up some of the things that we've seen in Asia, that hasn't been necessarily a permanent, significant shift from the physical stores to the online retail, because what we've seen, and what we're seeing in Europe as well, is that there are actually some quite significant capacity limitations, particularly for the online grocers at the moment. So yes, I think it will perhaps speed up some adoption of online shopping, but I don't think it's going to be the sort of the massive shift that perhaps we were talking about 2 or 3 weeks ago, given what we've seen in terms of the capacity issues at the moment. I think from a logistics perspective, I think it's reinforcing people's views that logistics is a very strong asset class to be investing into, though I think we might see some of the logisticians actually having some short-term issues with supply chain management. So it may not be plain sailing in terms of being able to collect 100% of the rent in the short term. And I think for offices, perhaps this is going to be the one sector where we see some of the longer term changes. It may be we start to see occupiers really significantly implementing much more of a sort of a hot desking, low ratio environment, because people understand how they can use technology to work from home and still be interacting with their colleagues. So I think you will see some of those working practices continue. At the beginning of the crisis, someone said, and it really stuck in my mind, is it only takes 6 weeks to create a habit. So I think that, if we're going to be sitting at home working like this for potentially 2 to 3 months, I think we will start to embrace some of these technologies as a permanent way of working. the interesting thing talking to our Asia colleagues is they are desperate to get back in the office. So I think they do also show that there's going to be a place for the physical office. That face-to-face contact is still really important at the end of the day. But I think technology is enabling us to also find alternative ways of working. Perhaps not every day from home, but more regularly from home, but with still that contact.
Great. Thanks very much, as ever, for sharing your insights with us today, Kim. Thank you.
My pleasure.